Hi guys, we want to start our class for today, and it is still a cost accounting class. Now, last time we did discuss on material issues, and we saw the various methods which you are able to apply in the determination of the cost of materials. So we talked about LIFO, FIFO, simple average, weighted average method. Today we want to wish, we wish to proceed to another topic. And the topic for today is actually on what we call contract costing. Contract costing. So at the end of the class, we shall have known what contract is all about, and then we shall also understand how we are able to cost a contract. A contract, as it refers, is basically a job which is big in size, for example, construction of a building, construction of a bridge, or construction of a road. Now, what usually happens is that there are companies who undertake construction for clients. Now, these companies, there are several clients from whom they receive the job for the request for construction. So each clients are kept, each client's work are kept separately in the accounts or in the books of the firm. Now we may be having client A, we may be having client B, and we may be having client C. All of these, basically, they have all the clients A, B, C. They may have received a request from them for the undertaking of the construction. And most of the time you find the constructions, the job takes place at the site of the customer. Of course, if it is a building, the building will take place at the land belonging to the client and so forth. So in that case, in this regard, for us not to go into loss as a firm undertaking the construction of the client, we have to we must carefully collect the costing information so that at the end of the day we are also remaining with something as profit on top of it. Now, in the preparation of contract account, it is just about accumulation of the various costs that are incurred. So the contract account is usually divided into three. The first part, it is where the cost is accumulated. The second part is where we determine basically the notional profit, that is the estimated profit for the contract, and then the third part is where we determine which profit is to go to the income statement for the current period, and which profit basically will will actually be pushed forward to the next period. So the contract account will is usually subdivided into those three parts, and once we start preparing it, we'll be able to see that it's actually very easy because all the costs that we are charged to the contract are debited. Now, that having been the case, of course, you will find that most of the expenses that are incurred in respect to each contract, they are charged to that contract directly. So the materials we are able to charge to a given contract directly and so forth. Some materials may be bought locally at the site. Some may be actually be brought to the site from the head office. So what is important for us to consider that in each of the in the preparation of this contract, we just have to consider what are the costs that we have incurred for this particular contract. It is contract B or A or C. What is the cost in total that we have incurred in basically undertaking this contract, this construction for the client? And it is on the basis of which then thereafter we obtain the profit on that particular contract. Now, we want to look at a question for the purposes of this discussion. There's a question there which we are going to share, and that question will actually assist us in understanding more of what we are supposed to do as far as this contract costing is concerned. So the principles of contract costing are usually the same. At the end of the day, when we shall have basically tackled this question, it will be easier basically for us to understand and apply it in another question. Now, basically, The question is talking about Ideal Construction Company Limited. The Ideal Construction Company Limited won the contract for the construction of a multi-story building at a cost of 200 million. The data relating to the contract for the year ended 31st December that year are given as below. So essentially, you've been told that there are data there is a material issued to the site, material purchased locally, of course, purchased locally at the site. There is direct wages paid 5,800. There is also accrued wages 350. There's plant purchased and installed 48,800. Then we have direct expenditure are also given there. So we call them direct because we incurred them to that specific contract that has been won by this particular company. So we have paid 1,780. Also, we have accrued 70. So accrued expenses are those basically which relates to the current period, but they have not been paid. So to the extent that they have already been incurred, we must charge it to that particular this particular contract. Also, we have establishment charges. We have materials returned to store. We have work certified and cost of work not certified. Now, we have aspect of what, when talk about work certified, periodically the work that we have done as a firm at the client's, as a firm at the client site are periodically evaluated and a certificate issued by an architecture in respect to the same. Now, it may happen at the end of the period, there are also other work that has been done but has not been certified. So we have the work certified, it has been given there. Cost of work not certified is also there. And then material issued on site on December 31st, it is 5330. Now, materials on site at the end of the period, those are materials that they have not been consumed. And so when a material has not been consumed at the end of the period, it means it was not used in the undertaking of the project. So that materials, that cost will not be counted when we are determining the cost of the job, the cost of the construction, the cost of the contract for that particular year. The value of plant on December is also given 41,500. Now, usually what happens if we are starting a contract, like building of a house, a bridge, or a road, there are usually machines that are actually specifically bought for that particular job. Now, the machines, they go, basically they undergo what we call depreciation. So at the end of the day, the year, you will find that the value of the machine will be lower than the cost that was incurred in purchasing it. So the difference usually is an indication of the depreciation, the amount that has been lost in terms of the value of the machine as a result of the usage. Now, we want to prepare the contract. We have the contract account. Contract account. So we are preparing the contract account. We are preparing the contract account. That's that. It takes the form of T format. So this is debit, just like any other account. That's on the left-hand side is a debit. And this is a credit. This is a credit. Now we start. So we start by, so we have you've been told the material issued to site is 80,000. Material issued to site is 80,000. So we have materials. Materials to site is 80,000. 80,000. So you can see we shall be on the debit side, we shall be posting the cost that we are incurring for this particular contract. Material purchased locally. You also have materials purchased. Materials purchased locally, which means at the site. It is 15,700, 15,700, 15,700. So we have, next we have the wages. So we have direct wages as the direct wages. So wages, there are two. We have wages which have already been paid and those which are accruing. As I've said, the accrued wages are those which have not been paid, but they belong to the current period. So we have the wages there, it is 5,800, I mean. That is what was paid for that year. And also we have the accrued, which is 350. So we add the two, 5,800 plus 350. We are able to get 6150. We are able to get 6150. So 6150. So that wages being paid and accrued. Also, we have the plant installed. So the plant that we have installed, we purposely for this contract. So plant installed. The cost is 48,800. 48,800. The next is direct expenses are also there. Direct expenses. We also have the direct expenses. Direct expenses. So in the direct expenses, what happens? We have the paid and we have the accrued as well. So we have the paid is 1780. So 1780 are the expenses that have been paid, but there are also the expenses which relates to this period, but they have not been paid. And that is 70. And that is 70. So we add the two, 1780 plus 70, and we're able to get 1850. We are able to get 1850. Then we have establishment charges. Establishment charges are 180. Establishment charges are 180. Establishment charges 180. Now, that's actually the cost that we have. But then we also have, at the end of the day, we have material returned to store. When materials were initially issued to the site for the purpose of the construction, but for one reason or the other, they are then returned back to the head office. Remember, we had said we are a company undertaking several construction contracts like road building, building of bridges, and so forth. So materials may be taken to site at the client site, but for one reason or the other, they are returned back to the store. So once they are returned back to the store at the head office can decide to take those materials elsewhere, and therefore it will not benefit the current contract. Now, what we do if the material return, it means it did not benefit this contract, and therefore we remove it. And the way we remove it from this contract is by crediting. So any materials returned to store, we credit, and by crediting it, it is simply a price that we are removing it from the materials that were initially taken to site, because such a material is not going to such materials are not going to benefit this contract. So we have material returns, materials returned to store. So we have, so it is 850. Again, at the end of the day, when the year is ending, remember most of the time the accounting informations are prepared annually. And so we are concerned with the cost that we have incurred for this contract in this year. So when some other materials are actually on site at the end of the period, it means they were not consumed that year, and therefore, for purposes of determining the costs that were purely for this year, we credit it again. So we have materials on site. At the end of the year, materials on site carried down. So in December, so we have there, this is 53.50, 53.30. So it is 53.30. So understand why we are crediting it, because these materials did not benefit this contract this year. And so by crediting, it means you are removing them from the materials that initially were bought locally for the contract or were issued from the head office to that particular site. Now, you also have plant on site carried down. You can see the plant installed was 48,800. But at the end of the year, when we are closing our books, the value of the plant has since been evaluated, and it is 41,500. So the 41,500. So you can see the difference between what was installed and the amount, the value at the end of this period. That is referred to as that is actually referred to as the depreciation. So value of plants carried down. Now, once you have done that, remember I said there are three portions that pertain to the contract. So the first part is for us to be able to get the total cost that has been incurred to date from the time we started at the beginning of the period to the time that when we are now ending. So we are closing these books. The first part. So the first part, we get the cost. So we call that the cost to date. So cost to date it's simply the difference between this and that. So these are the costs. We subtract this, and the difference is supposed to tell us the cost that we have incurred for this contract this year, this period. So the totals of this is 162,680. 152,680. So this is 152,680. This is 152,680. So 152 is the total of 80,000, 15,700, 6150, 48,800, 1850, 180. So if you add all those, they come to that. But if you subtract these items which are credited, then the difference is supposed to give you the cost to date, the cost that has been incurred for this contract up to this moment. So it is 105. The difference is 105,000. Now this cost to date, you bring it down here. Cost to date brought down is 105,000. And again, we want to compare the cost that we have incurred this period plus the value of the work that we have done. And the values of the work that are been done and two, they are those which we are those which have already been inspected and a certificate has been issued, and there are also those which we have completed, but they have not been, a certificate has not been issued. All of the two are work that has been done. So we have the cost, we have the work certified, and we have work not certified. All these work they have been done, only that one has been certified and the other one are not certified. So it may happen that as the work progresses, the architecture comes in and inspects the work that we have done, issues a certificate. It goes away. Then after it had gone away, we are still continuing the work. So at the end of the period, there was some job that we have already done, but really the inspector, the architecture has not come back to inspect the value of those works. So in summary, there are also work that have already been performed and done. So we have two categories of work. We have work certified, which is 150,000, and the other one is 3,800. So work certified is 150,000, and the other one is 3,800. Now, comparison of cost to date and the work done, which are two, will give you the estimated profit for that period. That estimated profit is referred to as notional. Is referred to as notional profit. Notional profit. Notional profit is referred to as notional profit. So if you add 150 and 38, that should give you 153,800. 153,800. So the difference between 153,800 and the 105 should be able to give you the estimates of the profit for that period. And that basically is 48,800. So the difference between this and that is 48,800. Now you can see we are done with the first part of the contract, in which our aim was basically to compute the costs which are incurred for this contract, this period. We were debiting all the costs, and then we credited all this material returned to store. The store in this case is the old office. So we are assuming that the store are maintained at that office. So when we say return to store, we are returning that to that office. Then we have material on site at the end of the day, the period, the year. They have not benefited this contract, this period, and that's why we are crediting. The value of plant carried down, basically, the difference between the two will give us the depreciation aspect, which then is a cost to that particular contract. Now, once we have done, the second part is for us to be able, the last part is for us to be able to determine the profit that we should take to the profit and loss account, notional profit brought down, the profit that we should take to the profit and loss account, and that which should be taken to the previous periods. Therefore, in that regard, we have the profit taken, and the profit provision, carried down. Now, in this case, the profit to be taken depends on the extent or the degree of completion of the contract. When the contract is at its early stages, like we have already done 20%, then no profit is taken. But if the profit, if the contract is basically is nearing complete, the contract is actually is in maturity, less like 60%, 50% has been done, then the profit that you take will be the notional profit, profit times 2/3 times cash received over value of work certified. So when the work is at maturity, then we apply this formula. But when it is nearing completion, like it is 75% and above, then the profit that we take is actually determined by notional profit. Notional profit is the estimated profit there. Notional profit times value of work, or times work certified, over the contract price. So where it is nearing completion, the profit we take will be notional profit over work certified or contract price. But if it is at its maturity, 60%, 50%, then we take notional profit times 2/3 times cash received or value of work certified. Now, if we apply that formula, of course, this if we apply this formula here, we shall find that the notional profit is 27,328. 27,328. So we are assuming this contract is at its maturity, and that you can actually be able to confirm by the value of work certified over the contract price. And if you look at that percentage, it will actually give you something that is basically means that it's not really nearing completion, but it is at maturity. Now, for that, if we compute, shall be having 48,800 times 2/3, 126,000 over 150. So we shall be having cash received is 126,000. The value of work certified is 150,000 there. So the notional profit is going to be 48,800. So if you compute those, if you compute that figure, you will be able to get 27,328. 27,328. Now that 27,328 being the profit and profit taken, then the difference is supposed to give you the profit provision which you are going to carry down, 21,472. 21,472. So that is that, 48,800, and that is 48,800. So that is essentially how the contract account is prepared, and it is usually in standard form. It is usually in standard form. Okay, now basically we have seen that's how to prepare the contract account, and you can also be asked to prepare the contractee account. The contractee is basically the client who has actually engaged us to undertake the construction for him. Usually, when you have been asked to prepare the contractee account, because there are only two possible ways in which a question may come from this area, either contract account or the contractee account. So for the contractee account, if it was to be prepared, contractee, and remember this is the client's account, then this contractee account is like a data account, a data. So when you sell goods on credit to a customer, it becomes a data, it becomes your asset. So the goods that you sell to a debtor is debited. So in this case also, we have rendered our services to that party and the work has been certified. So the extent that the work has been certified, that is our asset. So the work certified is credited here, work certified. And in this case, the work certified was 150,000. 150,000. Then we have what we call the cash received. Now your work certified, you debit, and the cash received, you credit. So the cash that we received in respect of this contract was basically 126,000. So you can receive it through bank or cash. So we have cash or bank account 126,000. So at this juncture, the balance is what is owing. So balance carried down. Balance carried down is basically the difference between that is 24,000. So that is that. That is 150,000. 150,000. Now that is how the contract is prepared, the contract account is prepared, and this is how the contractee account is prepared if the question asks the same. So as I've said, for purpose of contract account, you'll be told to prepare the contract account and it is left that way. Or you can be told, they can proceed and tell you also to prepare the contractee or the client's account. So in the client's account, you debit, work certified, and the cash that has been received is credited. The difference is what is owing from the client to the firm. Now, that's as far as the contract account is concerned. I think that is all you need to know on contract account. There's nothing much, there's nothing left as far as the contract account is concerned. So you have seen how it is prepared, and we have said that for you, when you are to prepare the contract account, it has to be subdivided to three. The first part where we obtain the cost for that contract for the current year. And the second part, we get the estimated profit, that which we get called notional profit. And the notional profit is simply the difference between the work that we have done, which are categorized into work certified and the work not certified, and the cost that we have incurred. So the difference between the cost and the value of the work that we have done is what gives us notional profit. Now, notional profit is this. So we bring it down, and then the third part will tell us which profit do we take to the income statement and which profit basically do we take to the previous period. That is basically the contract account, and the contract account I've said is that easy, debits and the work certified. And remember, the contract account is like a debtor's account. A class is a debtor to the extent that we have rendered services to him. So we debit the work certified, we credit the cash received, and the balance is actually the value balance carried down. So thank you for today's class. We shall pick again next time on another area. So have a good day.